Hello everyone, this is Kevin Zhao, your finance professor at MTSU. Today, I'm very glad to let you know that we are reaching the end of this course, Business Finance. And the chapter 11, Risk and Return, will be the very last chapter of this course. Now, let's get it started. In the previous chapter, we learned some very important lessons from U.S. capital market history. Most importantly, we found that there is a reward on average for bearing risk. And we call this reward a risk premium. And also we learned that this risk premium is larger for riskier investments. And in this chapter, we will extend our discussion for risk and return relationship. And we will do more work in quantifying risk and explore the true relationship between risk and return. And many people may have some misconception for that relationship between risk and return. They would say that, okay, higher risk means higher return. That's true. And if as investor don't want to bear any risk, then return's gonna be zero. Is that true? After completing this chapter, you would say it's not 100% true. All right, and higher risk may not indicate higher return. It is surprising? Well, we will figure it out. This chapter will help you to learn how to calculate expected return and the variance and standard deviation associated with expected return. So what is expected return? Expected return is the future return of your investments. And in the previous chapter, we also talked about risk and return, but those returns are past returns, not future returns. For any investors, past return doesn't mean anything. And what really matters for investor is the future return or expected return, as well as the relationship between future risk and the relationship between future risk and future returns. In addition, you will also learn a lot about the impact of so-called diversification by building a stock portfolio. And also, we will decompose the total risk into two different parts, systematic risk and unsystematic risk. And here you will learn the difference between those two very different types of risk. And the last one is very important, and it's very important not only for this course, but for the entire finance principle. That is so-called CAPM, or capital asset pricing model. And if we plot the formula graphically, you will see a line called a security market line. And the security market line is a very intuitive expression of the true risk-return trade-off in the financial markets. More specifically, we will address the following 8 topics in this chapter. First one is expected returns and variance for any financial assets. Second one is to introduce the idea of portfolio. And the third topic is associated with the announcement of the news from a corporation and the surprises delivered by the market and expected return that incorporates those surprises. And the fourth topic is to decompose the total risk into two different parts, systematic risk and unsystematic risk. Then we will discuss diversification and how can we deal with the portfolio risk by applying diversification principle. Then we will quantify so-called systematic risk by using a new measure of risk, which is beta. And the last 2 topics associated with security market line and capital asset model. All right. So this chapter covers pretty important issues, not only for this course, but also for the principle, for finance as a principle. And you will come across many times of those key concepts such as systematic risk, unsystematic risk, beta, security market line, and capital asset pricing model in many other finance classes. Now, let's take a look at expected returns. Once again, expected returns are future returns. In the last chapter, we examined a lot of facts associated with returns and risks for several different financial instruments in U.S. capital market history. And for investors, investing what happened in the past is important, but not as important as figure out what a future return will be for their investments. So this expected return deals with future return of individual financial asset investments. And here you see a formula, ER equals sigma PI times RI. And E here means expected, and R is the returns. And expect return once again means future return. And P here is the probability of many different scenarios, and RI is the return under each every future scenarios. Okay, for future return, you can make any random guess. Let's say your investment in Facebook will generate 10% return for next year. Is that good a guess? Obviously, it's okay, but it's not very good because the future return could be 12%, 5%, or even negative. And in order to capture the dynamics of future, we need to extend our analysis a little bit further. That's why we use this probability measure of future returns in this expected return formula. Now, let's take a look at one example to see how we can estimate the expected return for a typical stock. Now, let's take a look at an example to see how we can estimate the expected return of a typical stock. And here, in this table, you see that there are three states or three scenarios or three possible scenarios for a typical stock. Let's say we have 25% for economic recession and 50% of chance to get a normal situation in the economy and 25% chance to have a boom in this economy. And the sum of the probability is equal to 1. And under the first scenario, the recession, the expected return for stock A would be negative 20%. If it's neutral scenario, then return would be 15% and 35% if economy is in good shape. For stock B, it's different. If economy goes through recession, and this stock may generate 30% return. If the neutral scenario, then it would be 15% and a negative 10% if economy is in good shape. Now let's apply this equation. ER equals to sigma of PI, which is the probability, and RI is the individual return under every different scenario. And I here refers to different stocks. And I equal to 1 to n. Okay, let's continue our calculation. And first step for both stock A and B is to calculate the product of probability and expected return on each every scenario. For example, expected return for stock A should equal to negative 20% times 25% plus 15% times 50% plus 35% times 25%. And here we use weighted average method in estimating expected return. And the sum of those three items should equal to 11.25%. That is the expected return for stock A. And once again, expected means what will happen in the future. Now, you see the difference between a rough estimation of, let's say, 10% return for a single stock, a negative 20% for a single stock. I mean, the point estimation doesn't take consideration of many different scenarios, because at any given point, nobody can be 100% sure on what will happen in this economy and what will happen on stock return. It's better to consider multiple scenarios, incorporating different probabilities, and put all those scenarios together to get the average or expected return. And calculation for stock B can be seen from this table, and expect return for stock B equals, once again, 7.5% return on the recession scenario times the probability of 30% plus 7.5% return under the neutral scenario times 15% of probability, and plus negative 2.5% in the third scenario times 25% of its probability. And here you will get answer of 12.5% expected return for stock B. Well, after we address the expected return for individual assets by considering multiple scenarios, it's time for us to take a look at the risky aspect of those investments by using variance and a standard deviation. And the variance here equals weighted average of squared deviation. And this calculation is slightly different from the calculation variance that you learned in the previous chapter. In the previous chapter, we have historical observation of stock returns on an annual basis, and the variance equals to squared deviation, the sum of squared deviation divided by number of observation minus 1. And here we are estimating variance of future stock return. All right, and the method is different. As you see from the equation, sigma square, which is the variance, equals to the sum of several different items, and each every item equals probability times the squared deviation. And the deviation means deviation of individual return from its expected return. After we get the variance, then we take the square root to calculate standard deviation. Now let's take a look at one example to see how we can deal with the variance and the standard deviation based on expected return for both stock A and stock B. Once again, we have three scenarios: recession neutral boom with probabilities of 25%, 50%, and 25%. And for stock A, if the recession, then return is going to be negative 20%, if the neutral 15%, and 35% if economy is in good shape. Right. And previous calculation also already showed that expected return is 11.25%. And the next step is to take the difference between expected return under each every scenarios, then raise the square to get squared deviation. As you see, the squared deviation on the recession is 0.097656. How do we get that number? Well, that number equals negative 20% minus expected return of 11.25%. Then raise power of that difference. And if it's the neutral scenario, then the squared deviation equals 15% minus 11.25%. Then raise the power of that number, and that will give you 0.001406. And then we continue our calculation for the third scenario when economy is in good shape. And once we get the square deviation, then we do weighted average, and the weighted average equals the sum of square deviation times the probability. And when we add up those individual items, then we get variance 0.039, and the standard deviation is square root of that number, 19.8%. And the same calculation can be applied to stock B. And once again, first of all, we take the difference between expected return on each scenario and the expected return. Then take square times those squared deviation with its probability, and then we add those items together to get variance. And the standard deviation is the square root of variance. And in your homework, you will have many questions asking you to calculate, first of all, expected return, and the second, the variance of expected return, as well as standard deviation of expected return. And after several practice, you will be very comfortable with that process. Now, let me introduce a new concept of risk and return, that is portfolio. What is portfolio? Portfolio is a collection of many different assets. And the assets risk return impact how the stock affects risk and return of the portfolio. And the risk return trade-off for a portfolio is measured by portfolio's expected return and its standard deviation for individual asset. And a portfolio expected return is simply equal to weighted average expected return of individual assets in that portfolio. And in finance, calculating average is a little complicated, and many people say average equals sum of those observations, then you divide that number with number of observations. That is simple average. But here, in calculating average expected return in your portfolio, which has many financial assets, we needed to use weighted average. Why? Because the weights for each every different stocks or different securities are different. Some people may put 50% in stock A and 50% in stock B. Others may put 70% in stock A, 30% in stock B. So the weights could be different for individual assets. That's why we need to do weighted average. And here, ERP means expected return for the portfolio, and it equals the weighted average expected returns of individual assets. Now let's take a look at one example to see how we can calculate weighted average portfolio expected return. And here we have 5 assets invested in a portfolio. Investor spends $15,000 in A, $8,600 in B, $11,000 in C, $9,800 in D, and $5,800 in E. And the total investment is $50,000 to $100. And from those dollar amount, you probably won't have a direct measure of weights that investor put in each every individual stocks. And the first step here to calculate portfolio return is to calculate the weights of individual assets. And the dollar amount of investing in A is $15,000, and the total investment $50,200. Therefore, the weight of stock A or asset A in this portfolio equals 15,000 divided by 50,200. It approximately equal to 30%. And we do the similar calculation for B, C, D, E, and the weights for those individual assets are 17%, 22%, 20%, and 12%. And notice that the sum of those weights must equal 100%. The second step is to list the expected return for each every individual assets. And here you see 12.5% for A, 10% for C, and 8.5% for E, so on and so forth. And then we take the product of the weights and expected return for individual asset. And for asset A, the weight times expected return equals 30% times 12.5%. That will give you 3.735%. And for B, it equals 17% times 9.5%, which equal to 1.627%. And we do the similar calculation for assets C, D, and E. Once you get those individual items, then you put them together to calculate the sum, and the sum equals 10%. So this 10% is the portfolio expected return based on 5 different assets. And here we have alternative methods in calculating expected returns, and it incorporates different scenarios for 5 different stocks. And once again, the first step is to calculate expected return for individual stocks. And for example, for stock V, the expected return is 12.5%. And this number is based on 3 different scenarios: recession, neutral, and boom. And we do the same calculation for other stocks. And once you get expected return, then you need to find the weights for those different stocks. And the weights are listed on the second row: 30% for V, 17% for W, 22% for X, so on and so forth. And once you get weights and expected return, you take the products. You take the products of those 2 different numbers. And once you get once you get weights times expected return, you will have 5 different items. And when you put five different items together, you will get expected return for the entire portfolio. After we address the expected return for individual stock and your portfolio, it's time for us to deal with the variance and the standard deviation of the portfolio. And intuitively, you would say, hey, if we take weighted average of expected return to get portfolio return, then it makes sense for us to take weighted average variance or standard deviation to get variance and a standard deviation for a portfolio. Is this a correct method? Well, in most cases, it is not. It is not. And a portfolio standard deviation is not equal to weighted average of individual stocks standard deviation. Why? That is a very important question to answer. And after we introduce the idea of this diversification, you will see why. Well, portfolio variance can be calculated in this fashion if there's no correlation between different assets, and portfolio variance may equal to weighted average variance of individual assets, but in most cases it doesn't because of so-called diversification. Well, here we're gonna introduce that idea a bit later, and let's talk a little bit about total return of a stock based on systematic risk, unsystematic risk, as well as the announcements, new surprises, and how efficient market incorporating those announcements. Okay, here's a very odd example. In February year 2012, Humana, Hewlett Packard, and Johnson Controls joined a host of other companies in announcing operating results. As you might expect, news such as this tends to move stock prices. Healthcare company Humana announced that net income rose to $199 million compared to $103 million in the same quarter the previous year. Its quarterly earnings per share of $1.20 was previously what analysts had estimated for the company. Surprisingly, the stock price fell about 5.4% on the news. Technology giant Hewlett-Packard announced that its net income for the most recent quarter was $1.5 billion, a 44% decline from the previous year. Total revenue dropped by 7% as all the company's three divisions saw a sales decline. The company's stock price surprisingly rose 1.3% on the announcement. And the Johnson Control, the building efficiency and power solution company, announced record sales and earnings, but its stock price fell by 9%. Well, you would say, hey, this case is pretty odd because it's very obvious that Humana had a good news and both HP and Johnson Control had bad news. How come stock price increase when company had bad news and stock price decline when company had good news? Well, here let me talk a little bit about the surprise on the stock market and the surprises with announcement made by the corporation. And when company made announcement, it could be positive or negative, but this positive negative is relative to investors' expectation before the announcement, right? Let me tell you why. Humana stock declined when when company announced a tremendous increase in net income as well as EPS. Well, before the company made that announcement, investors had pretty high expectation on its net income and EPS. Perhaps the expectation is around $250 million for net income and higher than $1.2 of EPS. But what a company delivered disappointed investors. That's why stock price declined. Similarly, when HP announced that earnings has been declined by 44%. Before the announcement, investors may already had expectation that a company's earnings is going to drop more than that. So what a company did was better than what investor expected. Here you see stock price goes up and down, not based on absolute good or bad news, but based on so-called surprise, positive surprise or negative surprise. If company delivers positive surprise, which means the operating results is better than what investor expected, then stock price will go up. If it's opposite, then stock price will go down. And if market efficient, then those surprises will be incorporated into stock price when announcement is made. Now, let's look at the returns of a typical stock and risk associated with those returns. And the total return here has three parts. First one is expect return. Two parts. And the first one is expect return, and the second part is unexpected return. So, for example, for Humana in February year 2012, investors had high expectation. Let's say they expected stock price to go up by 10% for the following year, right? But what actually happened is there's unexpected results announced by the company. Company did well, but not as well as what investor expected. And the unexpected return here is negative 5.4%. So the total return for that stock equals expected return plus a negative item on the unexpected return side. And for unexpected return, there are two different parts. The first one is systematic part. The second one is unsystematic part. And the systematic part is the unexpected return due to systematic risk. For example, the rise of interest rates, the decline in GDP growth, so on and so forth, and those macroeconomic events will have negative effect on stock returns. And the second part is unsystematic portion. And the unsystematic portion has something to do with company's individual situation. If company had labor strikes, if company experiencing operation difficulties, then you will see negative items on the unsystematic portion. And overall, you will see that total return of stock has three parts. The first one is expected return. Second one is systematic portion, and the last one is unsystematic portion. So, what is systematic risk? Systematic risk is risk due to the financial market, this economy as a whole, and this risk is considered as a non-diversifiable risk, and it has a nickname of market risk. And examples for systematic risks are for example, changes in GDP. Let's say GDP growth declined by 2%, 3%, and that is a typical sign of recession. And inflation, higher than expected inflation, higher interest rates, so on and so forth. And those are macroeconomic events that will have impact not only on individual stock but the entire capital markets. And the risk due to those macroeconomic variable changes is called systematic risk. And the unsystematic risk associated with companies' individual events is diversifiable risk. And those are risk factors that affect limited number of assets. Right? For example, labor strike in company A will not affect the company that doesn't have labor strike. And if one company experiencing operation difficulty, doesn't mean all companies will suffer from the same problem. So it's a unique risk for a certain company, also called a firm-specific risk or asset-specific risk. And examples are labor strikes, parts shortages, operation difficulties, the turnover of management teams, so on and so forth. Those are unsystematic risk. Now, let me introduce a very important principle for investment. It's called diversification. Well, investors are expecting decent return, but there's a risk-return trade-off, and investor has to bear a certain amount of risk to earn that return. And return is desirable, but the bad thing that investor needs to deal with is risk. How can we deal with risk? Previously, we did a lot work in quantifying risk, developing statistical measures and do calculations. But those calculations only deal with measurement of risk. It doesn't deal with how to handle risk and how to reduce risk. And diversification is a great method that investors figured out to handle risk, to tame risk. And what an investor can do here is build a stock portfolio. Instead of investing in just one company, they put more than 5, more than 10, or more than 20 stocks in their portfolios. And by building portfolio, investor eventually found that, the risks can be reduced substantially. If you only hold one stock, it's very likely that standard deviation for that stock would be something around 40% or perhaps higher. But if you hold, let's say, 10 similar stocks with standard deviation stand around 40%. Surprisingly, when you put all the 10 stocks together, standard deviation of your portfolio is not 40%. It's much lower, right? And sometimes it can be reduced to 30% or even 20%. So building a portfolio can generate a so-called diversification effect, which reduce the risk of your portfolio. And the reason why building portfolio can reduce risk is very simple. Because when you put different securities together, there will be some offsetting effect for those worse than expected returns from one asset by better than expected return from the another, right? And stocks behave in different ways, and when one stock increasing, the other one may decline, right? And those increase decline can cancel off each other, smoothing the total return of your portfolio. That is the key for diversification, and that's why investors love to build a stock portfolio. Now let's take a look at how we can reduce risk by adding more and more securities into your portfolio. And if you only have one stock in your portfolio, it's very likely that the standard deviation of the investment would be something around 40%. And in this case, the standard deviation is almost 50%. Now let's try add more securities. Let's say you have 2 securities in your portfolio, and the standard deviation, standard deviation declined substantially from 49% to 37%, right? And here, adding one security only generates significant reduction in risk measured by standard deviation. Let's try more. Let's put 4 stocks, 8 stocks, 20 stocks into your portfolio, and you will see gradual decline of risk for your portfolio from 49% to 37% to 29% to 26%, all the way down to 21.68%. If you have 20 stocks in your portfolio, and you would expect the diversification effect to continue if you add even more stocks into your portfolio. You want to try more. Let's say 40 stocks, 100 stocks, 200 stocks, or even 1,000 stocks. Well, we can do that. We can do that, of course. But as you see, the diversification effect is diminishing, right? From 20 stock portfolio to 1,000 stock portfolio, standard deviation can only be reduced by about 2%, from 21% to 19%, right? And that effect is diminishing, right? And at a certain point, no matter how hard you try, no matter how many securities that you put in your portfolio, you can no longer reduce risk, right? And in this case, even when you have 1,000 stocks in your portfolio, you still have 19.21% of standard deviation for your portfolio. So from this table, we discovered that there are 2 very different animals. One is the risk that we can diversify away by adding more and more securities. The other one is the risk that we cannot eliminate or cannot reduce at a certain point. And this picture showed you those 2 different animals. The pink part showed you diversifiable risk. And diversifiable risk declined dramatically from 49% all the way down to 19% when we add more and more stocks, and that level can be reached around 40-50 stocks. And beyond that, no matter how stock that you put in your portfolio, the standard deviation stay the same. So in your portfolio, there's certain part of risk that you cannot eliminate or reduce, no matter how hard you try doing diversification. So The understanding of risk has been extended when we recognize there are two different animals in risk. One is diversifiable one, the other one is non-diversifiable one. And then we call diversifiable risk as unsystematic risk, and the non-diversifiable risk as systematic risk. As a matter of fact, systematic risk is caused by market-wide events or macroeconomic events such as interest rate changes, GDP growth changes, bad news in this economy, which will affect all companies. And the diversifiable risk as risk associated with individual companies' operations, labor strikes, disappointing earnings, operation difficulties, so on and so forth. And those events will only affect a single company or small set of companies, not all the company on the stock market. So from this point, we need to distinguish systematic risk and unsystematic risk. And the total risk the investor bears in their individual stock has two different parts. Remember, two different parts. First one is systematic one, the other one is unsystematic one. So if investors are smart, if they learn about diversification, then it's wise to build a well-diversified portfolio. Once investors have that diversified portfolio, then we would expect unsystematic risk to be eliminated or be reduced to a very low level. And in a well-diversified portfolio, investors are not supposed to bear any unsystematic risk. The only risk that investors need to deal with is systematic risk. And that is risk that cannot be diversified away based on diversification and portfolio building. So here is the systematic risk principle. There is a reward for bearing risk, but there's no reward for bearing risk unnecessary. And unnecessary risks are unsystematic risk. I mean, you can't take that part of risk, but reasons why. When you build a well-diversified portfolio, that proportion risk can be diversified away. So if we assume that all investors are smart, then the only risk that we need to deal with is systematic risk. So now let's go to the principle of risk-return trade-off. It's very likely that the true relation between risk-return trade-off would be the relation between expected return for your investment and the risk that really matters. The risk that really matters. That risk cannot be diversified away by doing diversification. Or the true relationship between systematic risk and its expected return. Okay, before we continue our discussion on systematic risk and unsystematic risk, as well as the true relationship that can be revealed by a security market line and a capital asset pricing model, let's take a short break.